Most economists blame the Federal Reserve for the Great Depression, yet the conventional history taught non-economic mainstream academia does not. Immediately prior to the Great Depression, the Fed did not want people investing in the stock market because it was viewed as gambling. To restrict this, the Fed sought to reduce the money supply to decrease the resources people had to invest with. To do this, the Fed increased the discount rate, the rate at which the Fed loans to other banks. This resulted in a decreased money supply and eventually massive deflation. Stock prices in the 1920s were priced accurately based on market conditions. Stock prices were based on the future success and profitability of their underlying company. It was only when these future expectations changed that the prices dropped accordingly in late 1929. Future expectations changed in 1929 and the early 1930s because of unprecedented tariffs being proposed by Congress, in addition to a falling money supply that resulted in increased interest rates and deflation. This frightened investors and made them think that companies wouldn't be very profitable in the coming years. Deflation encourages consumers to spend less money because their dollar will be worth more in the future. It also creates a credit crisis. Giving out loans is no longer very profitable compared to just saving money, and it is hard to incentivize people to take out loans. The deflation rate was so bad in the beginning of the Great Depression that even incredibly low interest rate loans from the Fed would have been unprofitable for banks. All of this resulted in bank failures, which created a death spiral of deflationary pressures. These failures were partially caused and exacerbated because the Fed was not loaning out enough money to banks and did not lower the discount rate soon enough. While the Fed was the primary cause of the Great Depression, there were other contributors and exacerbators as well. The Smoot-Hawley tariffs and Presidents Hoover and Roosevelt's progressive-era anti-free market policies. But the main culprit of the Great Depression remains excessive government intervention, not private enterprise. The single worst economic catastrophe in U.S. history occurred soon after the Fed was created and at a time of unprecedented economic policies. The Great Depression is an example of central planners and politicians who did not have the incentives, knowledge, or know-how to properly manage the economy. The government did not know what the consequences of its actions would be on a complex marketplace that it didn't understand.